All right. So for this class and for the next one, we're going to be doing a lot of review. Make sure you have a good understanding of what's going on before we kind of jump into the heavy lifting. So this is going to be a lot of review, a little bit of new information. So let's jump in. All right, just gonna go over just kind of reminders of what different things do and where they go on the financial statements. So common stock goes on your stockholders' equity statement. Equipment is on your balance sheet. Salaries payable. There's that word payable. You haven't paid it yet. That goes on your balance sheet. Service revenue, income statement. Utilities expense. So there's our other key word there. Expenses go on the income statement. Supplies, balance sheet, because it's something we own, we hold. Research and development expense, income statement. Land, thing we own, we hold, balance sheet. Income tax payable, we still owe it, so it's a liability, goes on our balance sheet. And interest payable, we owe it, balance sheet. So now let's take a look at how to put together some financial statements. And in this case, the examples we're going to run, they're not going to be clean, what we call good form. We're just going to get the kind of the down and dirty method on them to kind of just get the answer. But in the future, we're going to want you to prepare nice looking ones, what we call in good form. Right now, we just kind of want to go over like what goes where to get you more familiar with that. So let's start taking a look. So they want us to prepare the income statement for Longhorn Corporation, the statement of stockholders' equity for Longhorn Corporation, and the balance sheet for Longhorn Corporation. All right. So, and up at the top tells you a little bit about Longhorn Corporation, that they provide low-cost food delivery services to senior citizens in the year December 31st, 2021. It gives us some idea of what they've reported. In addition, they have common stock of 40,000 at the beginning of the year, and they issued an additional 4,000 during the year. And the company has retained earnings of 18,200 at the beginning of the year. All right, so let's start off. I know it starts off with income statement. So we want income statement, balance sheet, stockholders' equity. Yeah. I just like starting with the balance statement, and that's just my preference. So let's just start looking at like what goes where is really what we want to take a look at. So cash. So that's an asset. So that's going to be on our balance sheet because it's an asset, and we put our assets on the balance sheet. And then we have, let's see here, we have equipment. So equipment is also an asset. It's a thing we own. So that's also going to go on to our balance sheet. Now, delivery expense and salaries expense. So those are expenses. I'm just going to do a little thing here. And I think we skipped accounts payable. Payables are liabilities. So that's going to go on our balance sheet, but these expenses are going to go on our income statement. All right. So service revenue, that's money in. That's going to be our income statement. Cost of goods sold. So that is a portion on our income statement. Buildings, that's an asset. Supplies, that's an asset. Salaries payable, that's a liability. And assets and liability go on our stockholders' equity. oh, why did I say that? Go on our balance sheet. Okay. Do not put those on the stockholders' equity. That is bad. Okay. So what we're going to do is, like I said, I just want you to get this kind of moving. I don't necessarily need you to start doing those in good form yet. This is just so you can get your idea. So if we look at the bottom here, there's kind of the example of our income statement. So let's look at the item of our income statement. So remember, their service revenue is 67.7. So it takes care of that, right? And that's where we start on our income statement is we're going to put revenues first, but then we're going to put cost of goods sold. So that was 53,400. Again, that's on our income statement. Then we're going to list out our expenses. So what we would normally do here is we would go ahead and say, here's our revenue. And we would subtract out our cost of goods sold to come to a gross profit. All right. In this example, we're going to keep going and we're going to go ahead and take out our salary expense because our salary expense was part of it, our delivery expense because that was part of it. And it comes to total expenses 61,500. And I just want to double check that we make sure we got everything. So that's it. And we subtract our 61.5 from our 67.7, gives us 6,200 of our net income. So we're done essentially with our income statement. So let's take a look at the balance sheet. Now, remember, balance sheet represents our assets plus liability plus stockholders' equity. Okay, so what we're going to do is we're going to start off with our assets. Now, the first thing we do, we start off from the most liquid, and the most liquid of everything is our cash. And our cash is $1,200. Right. And then we have equipment and we have buildings in our assets that we need to list. I'm just double checking. All right. So when we go from cash, there's a few other things that we would list, usually notes payable, quick turnaround. But in this example, we don't have those, so we're not going to worry about them. And so what we're going to do is move to what we call property, plants, and equipment. This is kind of our big items that we own. And so we're going to start with property, which is land. Oh, before we move on, supplies usually goes up here because it's a pretty, not as liquid as cash, but we can usually move it. So we're going to put supplies. That's 3,400. So then we're going to go land on our big ticket item stuff. Land, which is, how much did we have for land? Dun, dun, dun. Did we have land? Well, look like we did. All right. I was so used to kind of having those there, but we have buildings. So we're going to go ahead. Buildings is a big ticket item. I think we have 40,000 there, right? All right, 40,000. We're going to add these up pretty quickly because remember, assets equals liability plus owner's equity. Switch over to my mouse. All right, so we have 40,000 in building. Oh, we did have an equipment item, so that's 29,000. We would put that under, we would put that before, we would put that after building. So we're going to put 29,000 in that. While we double check things and make sure we got everything off the list. All right, and then we add up our cash, which is 1,200. So our smaller items. And then what was it that we had? We had supplies, just 3,400. So normally in good form, we would add each of these things up in each section. So we're looking at, we have 73,600 in assets. Well, then we would do a liability section below. Now, in this case, we have two liabilities. We have salaries payable and accounts payable. So we're going to subtract, remember they equal each other. So I'm going to subtract the 4,400. And we would just list those. All right, look up a balance sheet and you'll see how they're supposed to look. We're just kind of getting the down and dirty work done. And salaries payable is 800, so that seems like one employee. Accounts payable 4,400. That means we still have 68,400 left over. So what happens is that we remember assets equals liabilities plus owner's equity. Since we only have these small amounts in accounts payable, and I'm just double checking, and in salaries payable, that means there's $68,400 left in owner's equity or in owner's capital, depending on the size of your company or whether it's public options or not. So now the stockholders' equity statement, we're gonna take a look at that or build one. So what we want to do is start with our value on those of how much common stock we started off the year. So the company had retained earnings at 18.2. So we had common stock at 40, which we issued. We went ahead and added, so we would put our 40,000. Make sure I still have my drawing abilities. So we put our 40,000. We issued an additional 4,000. That equals 44,000 of what we have is equity stockholder. We didn't have any additional we haven't talked about it, but there's treasury stock, which is when we buy back our stock, when there's so we calculate that up to be there. No, we also add our retained earnings, and it does say we have retained earnings of 18,200. So we would add that up with the 44,000 plus 18,200. I'll let you add it up, and that gives us the total of our shareholders' equity as far as any common stock accountability there. So that's just a quick way to solve for these different financial statements. This was a very sloppy version. This was just kind of, to be honest, like when we do it, we do it on a piece of paper just to make sure everything's okay. We'll worry about the good form later. I'll give you templates to work with. But for now, I just wanted you to see like how that's coming together and how we put those financial statements together. You will, for this class, have to put together these financial statements yourself. So good to review from other videos, how to do that. All right, let's keep on moving. Let's do some more review. In this case, just a reminder that cash is an asset, service revenue, the revenue, supplies are an asset, buildings are an asset, advertising expense is an expense, equipment is an asset, interest expense is an expense, accounts payable, liability, dividends a dividend, and a note payable is a liability, balance sheet item. Very important to remember that. We haven't paid it yet. We owe it to someone, and we put liabilities on our balance sheet. So we're going to take a look at a case, right? So Tony Matheson plans to graduate from college in May 2021 after spending 4 years earning a degree in sports and recreation management. Since beginning T-ball at age 5, he's been actively involved in sports and enjoys the outdoors. Each summer, growing up, he and his father would spend 2 weeks at a father and son outdoor camp. These fond memories are part of the reason he chose his major. He wants to remain involved in these outdoor activities and provide others with the same adventures he was able to share with his dad. He decides to start an outdoor adventure company. However, he's not sure he has the business background necessary to do this. This is where Susie Ramos can help. Susie also plans to graduate in May 2021 with a major in business. Susie and Tony first met their sophomore year and have been friends ever since, as they share a strong interest in sports and outdoor activities. They decide to name their company Great Adventures. They will provide clinics for a variety of outdoor activities such as kayaking, mountain biking, rock climbing, wilderness survival techniques, orienteering, backpacking, and other adventure sports. Okay. So let's work through some questions and apply some of the knowledge we've acquired so far. What are the 3 primary forms of business organizations Tony and Susie might choose from for Great Adventures? And explain the advantages and disadvantages of each. And which form would you recommend for Great Adventures? Well, we know since there's more than one person, partnership, they could go corporation and start issuing stocks where they distance themselves. They can also form an LLC. And in this case, since they are small, I would suggest an LLC because corporations do have a lot of back-end paperwork to do. Now, what are some of the financing, investing, and operating activities that a company like Great Adventures likely have? So financing, they're probably going to have to borrow money for equipment to buy all this stuff for the store. So let's just assume that. Investing, well, they'll probably have to, think it their activities. They want to do activities. They're probably going to buy equipment of a large nature. Don't know exactly, maybe a couple of vans. That would be investing. And operating, that would be taking money for services. Usually it seems from here for tours. So those would be examples of financing, investing, and operating. Specific account names for assets, liabilities, stockholders, equities, revenues, and expenses would the company likely use to record. So for assets, cash, they're probably going to have a notes or take on a notes payable, or for a liability. Stockholders' equity, well, that's only going to apply if they issue stock, but let's go for that. Revenue, so service revenue for their tours, and expenses at the gas for their vans that I had them buy. That would be a fuel expense or a vehicle expense. So those are some likely categories. And to report company performance, Susie plans to prepare the 4 primary financial statements. Explain the type of information provided on each statement. So a reminder, balance sheet has our assets, things we own, liabilities, things we owe, and stockholders' equity, so how much value we have in a company. Income statement shows our revenue and expenses. Stockholders' equity shows the value that stockholders have in the company. And our cash flows show the translation of cash operations from accrual operations. And we'll talk about accrual information. Oh, look at that. What a segue. So in accrual accounting, we record revenues when we earn them, and we expense them related to the revenues. Okay, so what does that mean? And that's why what we're learning here is such a big thing. So what we're learning is something called the revenue recognition principle. So we record revenues when we earn them, and we expense related to those revenues. So what does that mean? So let's use the example of magazines. So usually when you buy a magazine, like it's a year subscription, but we only record the revenue when we earn them. So just because I sold you a year's worth of magazines, I haven't earned that revenue. I can't record revenue for a magazine I haven't sent you yet. It's in December, we're in January. Same thing with cruise tickets. You usually buy a cruise ticket ahead of time, but the company only recognizes that revenue when you take the cruise. Until then, they haven't recognized the revenue. So there's a timing principle that goes along with this. And that's why one of the major reasons we do accrual accounting. FedEx, like I may have ordered the box, may have paid you to come pick it up, but you haven't delivered it. So we don't record revenue yet because you haven't done it. Reebok, it's a little different. When you go to the store, you initially like a product, you immediately recognize the revenue because you took possession of the item. Movie ticket, kind of the same thing. You buy it when you go in. Accounts payable. So a lot of times accounts payable, so think of like a utility bill, is 30 days after. You recognize the expense when you submit the payment on that. But so even though we got the bill, we don't recognize the expense until we actually pay the bill. And so it takes a little bit getting used to. It does, as we go through this class, will make more sense. But we're still kind of putting the pieces together because we are so used to doing things in a cash basis. So what we're doing is we're doing a matching principle. Expenses are recognized in the same period where revenue is recognized. So if I sold you that magazine in January, the items it took to get you that magazine done in January are what I'm going to recognize to send that to you. They match up. So for example, all right, so we're going to learn something here. So, and what I want to show you here is something, it's a little tool we use a lot of times called the T account. And this represents our debits and credits. Really, so like, say we're going ahead and we're crediting 300 on this side for something, but we go ahead and reduce it by 50, we have a balance over here. Now, one of the things I did want to show you and kind of talk about right now is something like we don't recognize, even though we get paid for something, we don't recognize everything as soon as we get it. We have to perform that service. So even though we have revenue, we have to expense it out. And that's what we'll do is we'll go ahead and expense it out during the year. And we'll do more detailed examples in there. But just know that's like what we'll do at the end of the year to recognize that we did perform the service, just to make sure. Now, of course, there's exemptions. And one of these exemptions is like we want to match things up with each other, right? But what if we have something we can't match up? So like, let's say I did a commercial and people bought stuff because of the commercial. I can't really say that a particular commercial is a reason that someone bought something. So when we have like things like that we can't properly match up, or they're usually what we call administrative costs, we call those period costs. We expense them to the period, the time that we're doing. So if we did a marketing campaign in January, we paid the bill in January, we're going to put them in January. All right. And so we're almost at the end for today, but this is the foundation of why we do the stuff we do. Because cash-based accounting, which we're used to in like our personal lives, we record cash when it's received and expenses when the cash is spent. The difference is timing. So we record revenue when you just give me cash. But that makes things difficult, like when we're billing, when it's 30 days out. It makes things difficult to record things such as depreciation, because depreciation is not a cash item, and we'll talk about depreciation in the future because that's super important. And so accrual accounting accounts for a lot of the details in business, where cash accounting kind of makes more sense on a consumer side. Now, one of the things I want to remind you is next week we're going to be talking about the ethics case. I believe that was in their week one notes. And so just remember to read that case and to be prepared. The next video is going to be, again, a little bit of information. We're going to try to do some review, and I'll see you in the next video.